Shell game? Fiscally prudent? Legal corporate malfeasance? Corporate stock buybacks have inspired great debate ever since a Reagan-era tax law change and a Clinton-era deal sweetener. Well, buybacks are back in the news today because in April, U.S. corporations announced a staggering $233 billion in stock buybacks, the second highest monthly total ever recorded. But unlike previous bonanzas, this isn't a sign of economic strength or corporate confidence. In fact, it's quite the opposite. This time, it's a bit of a red flag. Corporations aren't plowing this cash into their businesses because they see these amazing growth opportunities on the horizon. They're not investing in innovation, workers, or expansion. Instead, some argue they're spending billions to prop up their own share prices in a cynical bid to boost executive bonuses tied to stock performance. So let's talk it out. UNFTR. Corporate America is sitting on a mountain of cash. According to the St. Louis Fed, corporate America came into the year with $209 billion in cash reserves. Now, this kind of dough can be used to issue dividends to shareholders, invest in projects, pay down debt, bonus employees, invest in the market, chill for a rainy day, or purchase back shares of its own company. And that's what we're seeing thus far in 2025 in a rather significant way. One of the major criticisms is that companies that participate in buybacks are doing so to artificially inflate their stock prices. The current buyback bonanza seems to reflect a desire to boost share value rather than investing in the future, kind of a vote of no confidence in the economy and the Trump administration's economic stewardship, all while executives cash in their stock options before the whole house of cards comes tumbling down. So today, we're unfucking the twisted history of how we got here, from the Reagan-era deregulation that unleashed this monster to the Clinton-era tax policies that supercharged executive greed and the pathetic attempts of the Biden administration to rein it in with a microscopic excise tax. So let's start with the numbers, because they're truly staggering. As I mentioned, in April alone, corporate America announced plans to buy back $233 billion of their own shares. And this includes companies like Apple, Visa, Wells Fargo, Delta, and 3M. They're all getting in on the action. According to Deutsche Bank, over the past 3 months alone, buyback announcements have exceeded $500 billion. That's $500 billion that could have gone to raising wages, funding research and development, or investing in new facilities. Instead, it's being used to manipulate stock prices and enrich shareholders, primarily the wealthiest Americans who own the vast majority of stocks. Now, you may have noticed that the stock market has been unnerved by the tariff war, quickly retreating from record highs in 2024. But in the past week or so, the market rebounded. Now, if you guessed what I'm going to say next, then you're a regular here. Bravo. Let's repeat our mantra with religious zeal. The market is not the economy. The market is not the economy. Now, that said, there are signals that one can take from investor behavior that show you exactly what they're thinking about the economy. The recent rebound in the market would normally be interpreted as kind of a good thing. The market uses a phrase called priced in, which means that it's always ahead of the real economy. So the bulls and the optimists would say that investors are looking past the trade war and thinking that things are going to rebound on the flip side. What makes this round of buybacks troubling, however, is the timing and the context. Just a month earlier, in March, many of these same companies were hoarding cash, but as soon as their first quarter earnings reports turned out better than feared, they immediately pivoted to shoveling the cash into shareholders rather than investing it into growth. And everyone knows that we're front-running inventory ahead of the tariffs and that earnings reflect the prior quarter of activity. In fact, most executives on earnings calls were predicting tough sledding ahead. So piling cash into shares was actually a defensive move. But why? Why do it? Well, this is corporate short-termism at its most damaging. It reveals a fundamental lack of faith in the economy's long-term prospects under the current administration. Companies are effectively saying, we don't see promising opportunities to invest in our businesses, so we might as well artificially inflate our share prices instead. And inflate they do. Stock buybacks reduce the number of outstanding shares, which mathematically increases earnings per share even when actual earnings haven't grown. In fact, if you look at the trajectory of earnings over the past 50 to 80 years, PE ratios have been steadily climbing and they spike during recessions. And that's kind of what we're heading into right now. It's financial engineering masquerading as performance, a sleight of hand that props up executive bonuses while adding zero value to the economy. But it wasn't always this way. To understand how we wound up in this situation, we have to go all the way back to 1982. That's when Reagan's SEC chairman, John Shad, a former Wall Street executive, because of course he was, implemented Rule 10b-18. Now, before this rule, stock buybacks were generally avoided because corporations could be interpreted as illegal market manipulators if they did it, which, let's be honest, that's what it is. You're using corporate funds to influence your own stock price. In any other context, we would call that market manipulation. But the Reagan-era SEC created a convenient safe harbor provision that essentially legalized the practice. Rule 10b-18 gave corporations a green light to repurchase their own shares without fear of being accused of manipulation, as long as they followed some very permissive guidelines. It was deregulation at its finest, another win for the free market fundamentalists who dominated economic policy in the 1980s. Now, as you can see from this chart, the impact was dramatic. Through the 1990s and early 2000s, buybacks exploded, and by the 2000s, the S&P companies were spending more on buybacks than on dividends. By 2007, S&P companies were spending nearly 90% of their earnings on share purchases and dividends, leaving precious little for investment, research, or workers. This wasn't an accidental side effect. This was by design. It was a deliberate shift in how American capitalism functions, prioritizing short-term shareholder returns over long-term investment and broad-based prosperity. Now, UNFTR listeners know how I feel about the Clinton years. In so many ways, Clinton was Reagan on steroids, especially when it came to deregulation and financial engineering. So if Reagan-era deregulation opened the door to buybacks, it was a Clinton-era tax policy that turned them into an executive compensation bonanza. In 1993, the Clinton administration pushed through Section 162M of the IRS tax code, and like so many new Democrat initiatives, on the surface, it sounded like a progressive policy aimed at reining in excessive executive pay. The law capped the corporate tax deductibility of executive compensation at $1 million per executive for publicly traded companies. Problem solved, right? Wrong. The law included a massive loophole. Performance-based pay, such as stock options and certain bonuses, was exempted from the cap. The results were the exact opposite of what was ostensibly intended. Rather than limiting executive compensation, Section 162M caused it to explode. Companies just capped base salaries at $1 million and shifted compensation to stock options and performance bonuses tied to, you guessed it, share price. Between 1992 and 2000, CEO compensation at major firms skyrocketed from $4.9 million to over $20 million. That's a 400% increase. And the vast majority of this explosive growth came in the form of stock options and performance-based pay that was fully tax deductible for corporations. The perverse incentives created by this policy can't be overstated. By tying executive comp directly to stock price, Section 162 gave corporate leaders an overwhelming personal financial incentive to boost share prices by any means necessary, including stock buybacks. So suddenly, CEOs could enrich themselves at unprecedented degrees by just directing corporate cash towards buybacks rather than investments. I mean, why would you build the business in the long term when you could just goose the stock price in the short term and cash out your options? And that's exactly what's been happening. This Clinton-era rule didn't just fail to control executive pay, it supercharged it and fundamentally changed the incentive structure for corporate leaders across America. It was neoliberalism at its worst, a policy that claimed to address inequality while actually accelerating it. Fast forward to 2022, after decades of buybacks draining productive investment from the economy and widening inequality, the Biden administration finally took an action with a pedo tweeyu measure. What's pedo tweeyu, you might ask?
It's the worst acronym ever made up, and we realize now it was a stupid thing to do. It stands for fishing in the ocean to warm it up. It's time for pedo tweeyu.
Stupid, right? These are the little ways I amuse myself. As part of the Inflation Reduction Act, a 1% excise tax was imposed on stock buybacks by publicly traded corporations. Yes, 1%. According to federal estimates, the tax was going to raise $7.9 billion in 2024. Now, it sounds like a lot, right? But it's really a rounding error compared to the hundreds of billions of dollars that corporations spend on buybacks every year. I mean, this isn't even a slap on the wrist. So the SEC also implemented new disclosure requirements in 23 and 24, forcing companies to report daily repurchase activity on a quarterly basis and provide qualitative explanations for their buyback programs. And transparency is nice, but it doesn't address the fundamental problem. These half measures were predictably ineffective, and the evidence is right in front of us. April's $233 billion buyback shows that corporations aren't remotely deterred by a 1% tax or enhanced disclosure requirements. The Biden administration's approach to buybacks exemplifies the fundamental weakness of centrist Democratic economic policy, identifying real problems but lacking the political courage to implement real solutions. It's just regulatory theater, the appearance of action without the substance. The defenders of stock buybacks, and there are many in the financial media and neoliberal think tanks, argue that buybacks efficiently allocate capital back to the shareholders, who can then reinvest it into more productive ventures themselves. Now, to use an economic term, this is bullshit. The reality is that buybacks have coincided with a massive decline in productive investment by American corporations. The share of GDP going to corporate investment has been trending downward for decades, even while profits soared. Meanwhile, inequality has also skyrocketed, with the gains from economic growth increasingly concentrated among those who own significant amounts of stock, primarily the wealthiest Americans. And research has consistently shown that buybacks often come at the expense of workers, R&D, and long-term growth. A 2018 study found that companies that do buybacks cut investment in the following year. So that's what we're seeing right now, as they've been telling us in these earnings calls that they're going to cut investments all the way through 2026. So that is a real-time scenario. Another study from the Roosevelt Institute found that corporations have increasingly used debt to finance buybacks, leaving them even more vulnerable to economic downturns. Now, perhaps the most damning is the evidence of insider self-dealing. Another SEC study found that the executive sale of personally owned stocks increased from an average of $100,000 a day to $500,000 a day immediately following their company's buyback announcements. In other words, corporate executives are using company money to pump up stock prices and then personally cashing out at those inflated prices. The macroeconomic impacts are just as troubling. By diverting corporate cash from productive investment to financial engineering, buybacks contribute to secular stagnation, wage stagnation, and increased financial fragility. They're a major factor in the financialization of the American economy, where paper wealth grows faster than the real economy. That's the phenomenon that Giovanni Arrighi was referring to in his breakdown of hegemonic decline, as we discussed in our recent episode on the repo markets. When an economic superpower reaches the financialization phase of an economy, sacrificing labor and productivity along the way, it looks for ways to engineer profits that benefit fewer and fewer people in the investor class. So what is to be done about this massive ongoing transfer of wealth from workers in the broader economy to shareholders and executives? Well, real reform would acknowledge that the Clinton-era comp cap didn't work. We got to close that loophole that exempts performance pay from the $1 million deductibility cap. This would remove one of the primary incentives for executives to pursue buybacks at the expense of productive investments. Also, the excise tax on buybacks should be raised significantly to force corporations to think twice about whether buybacks are the best use of capital compared to investing in their own workforce. And before anyone cries foul at a higher level of taxation, corporations still have the option to reward shareholders through dividends. So my overarching opinion, probably due for a much deeper dive another day, is that corporations should be taxed at a much higher rate. Hit the corporations for taxes at the root of it all, and the individuals for tax evasion. The fact that corporations are sitting on so much, quote, dry powder that they can blow hundreds of billions of dollars on buybacks is a direct result of decades of declining effective corporate tax rates and massive loopholes in the tax code. And despite the headline corporate tax rate, many profitable corporations pay little to no federal income tax. The Trump tax cuts of 2017 made the situation even worse, flooding corporations with cash that they largely used for buybacks. Restoring corporate tax rates to their historical norms, 35% and higher, and closing loopholes would reduce the cash available for financial engineering and fuckery and create stronger incentives for the productive investment. This is where Republicans and Wall Street types lose their minds, saying we need to make doing more business in the United States more attractive, not less attractive. We got to keep tax rates low. Well, maybe if you hadn't privatized so many public benefit corporations along the way or busted up unions to the point where only 11% of U.S. workers have union membership, or that according to the National Bureau of Economic Research, more than 1.5 million U.S. taxpayers hold money in offshore havens, and 60% of the associated funds are held by the top 10% of the 1%, maybe we wouldn't have to do this, now would we? At best, we're talking about a couple thousand Americans hiding funds that grow exponentially each year because they're putting upwards of $30 billion more every year into their pockets through tax evasion. And thanks to reporting from the ICIJ that sifted through the Panama Papers and other leaks, we now know that an estimated $10 trillion is stashed offshore, and that a little more than $3 trillion of it is from Americans. So I don't want to hear your bullshit about fairness and competitiveness. But ultimately, addressing buybacks is just one small part of a much larger project to restructure the American economy to serve the many rather than the few. Until we muster the political will to make significant changes, we're going to continue to witness the spectacle of corporate America cannibalizing itself for the benefit of executives and wealthy shareholders, all while the real economy stagnates and ordinary Americans struggle to make ends meet. The April buyback story isn't just a financial news story. It's symptomatic of a deeply, deeply flawed and diseased U.S. economic structure, one that prioritizes wealth extraction over wealth creation. And it's time we call it what it is: legalized theft on a massive scale. Here endeth the lesson.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world needs. Another basic white guy